INREV was established in 2003, very briefly about us, to promote these goals, and we do that through concrete areas such as research and market information, development of professional standards, such areas as corporate governance, reporting, due diligence, and sustainability. Also tax information. Our public affairs efforts were established only very recently. In 2010, our management board decided that this was an area we couldn't delay getting into, and so we have been in the last 15 months or so trying to develop a public affairs program, which culminated in the opening last month with the very able assistance of Bram de Pauw from CBRE and an office here in Brussels to pursue our public affairs agenda here with policymakers. We also do communication and events for our members and training and education as well, which, by the way, our training courses are open to non-members. Let me talk briefly about the general scope of real estate investment in Europe. It is over 5 trillion euro in combination, which is a number so large I find it hard to get my head around. Let me then say, by way of comparison, that it's only slightly less than the total investment of institutional investors in government bonds and in equities. So it's quite a large investment class. We represent an area where major institutional investors, primarily pension funds and insurance companies, but also investment banks and sovereign wealth funds, can invest their money and diversify their portfolios in a way that bring benefits to the investors, which I want to emphasize here, something I think policymakers sometimes lose sight of, ultimately are pensioners who rely on that 800 euro a month pension check, insurance policy holders who rely on their insurance companies having the funds available to meet the insurance liabilities that they're paying for. So our large institutional investors are not some abstract financial sector players. They're actually real organizations that have a social role that is critical to each of us as well as to our grandparents and neighbors. So the major investors in non-listed real estate as well as in real estate, in addition to individuals, of course, I just mentioned. But the role in the economy is astounding, actually. The means of accessing real estate as an investment are threefold. Direct investment, everyone knows, is investing directly in buildings by owning them. That has several disadvantages for institutions that don't want to set up the expertise and the infrastructure to actually manage and lease buildings. That's where a lot of you in this room come into play. Investment through the listed route or through the non-listed route is a really attractive way for investors to access the diversification benefits, the long-term stability of real estate as an asset class without having to actually actively manage the real estate assets themselves. There are a lot of advantages to investment in real estate as an investment class. Diversification, as I just mentioned, but in addition, they are long-term investment, lower volatility relatively than equities and bonds. They are counter-cyclical, which adds to their diversification value. They offer a potential inflation hedge, income generation, and an opportunity for investors to implement their ESG policies, which is something that Stefan was touched on in his comments on sustainability, which, by the way, we have also reporting recommendations on sustainability as well, which mirror very closely EPRA's. So, the distribution of real estate investments by sector. You can see from this slide that real estate is primarily invested, at least from the perspective of institutional investors, in office and retail assets, but residential and industrial assets also play a very significant role, as do the newer sort of developing areas such as housing, infrastructure, leisure, and healthcare. The role of real estate is not simply as an investment class, however. Real estate creates substantively to job creation in Europe, and this is a really key point that is at the crux of a lot of what we are trying to do in the public affairs area. Real estate investment creates jobs in construction, in management, in maintenance, supply, finance and legal, and a number of other areas. I want to emphasize here that real estate investment is not exclusively in construction and development. As a matter of fact, for non-listed real estate investors, the overwhelming majority of investors invest in core assets, and so there are already buildings that are built with long-term tenants, and they provide a stable asset that provides an income flow and long-term value retention. But real estate also provides, through the creation of jobs and through the development in the infrastructure, a contribution to GDP growth, as well as to social cohesion. And these are also important factors as we are making the arguments to regulators about what the potential impacts of regulations on real estate investment are. Let me say the current investment environment actually poses a number of challenges for investors to obtain adequate returns on capital. And one of the main challenges is actually regulatory initiatives. I mean, of course, everyone knows we're in the midst of a financial and economic malaise, but regulatory initiatives also are playing a significant role in the ability of investors to get returns on capital. So I want to discuss that a bit. The purpose of the regulatory initiatives that we are looking at, and I'm talking here about Solvency II, AIFMD, and AMIR in particular, are designed to reduce systemic risk in financial markets and to protect investors, which are actually both goals that we heartily applaud. The difficulty, though, is that these regulations, which would require higher capital reserve charges in the case of Solvency II, possibly in the case of IORP, which would apply to pension funds as well, that's not known yet, but definitely in the case of AIFMD, will certainly increase the costs to investors, and that has the effect of reducing returns for investors, and that is a problem. The impact of the wave of new regulations is actually unknown, and especially taken together. As you all know or may know, the European Commission is required to undertake a quantitative impact study of each proposed regulation. Those, however, are, if I can say so, as both an economist and a former regulator myself of more than 10 years, not impressive in their thoroughness and economic sort of viability. And they, in any case, do not consider the cumulative effects of regulations. So the concern we're looking at is Solvency II piled on top of AIFMD, piled on top of AMIR, and the impacts that will have for returns on investment and therefore ultimately to investors. The impact on job creation, GDP growth, and the social effects of the regulations are not particularly taken into effect in the QISs as well, and that's something that we think is actually a critical set of factors that should be considered. We think that this requires regulators to proceed with caution. Low returns could make real estate a less attractive investment class. Just as a bald statement, it's true. That could result in less investment, and that could have a ripple effect through the European economy. And I raised before the issue of job creation, GDP growth, the impact on beneficial impacts on sustainability changes, all of which the real estate sector is in a position to make a positive contribution toward, and these regulations could actually undermine the ability of real estate to do that. So I have a modest proposal, actually, for European regulators. I would start by suggesting that the impact of regulations should be understood before they're enacted and not after. And I would also suggest that a careful cost-benefit analysis be conducted of the regulations. Specifically, do the benefits of the proposed regulation really outweigh the costs, especially at a time when we need growth in the European economy to pull us out of the current economic and financial malaise? Or if we're not looking at a growth environment, if we're looking at potential losses of jobs, potential austerity measures, oops, oh dear, well, this will keep working. The property sector offers a real opportunity to keep people employed, keep the economy moving, and keep things on the right track, whereas any measures taken which would create disincentives to invest in real estate could directly undermine those efforts. So, in conclusion, one thing is very clear, and that is that capital can be and is deployed globally. Asian and other developing nations, as well as Central Europe, Central America and North America, are hungry for investment. They have growth agendas, they're starving for investment, and they're doing what they can to make themselves an attractive investment environment. The job creation and GDP growth in Europe, which partially depend on European real estate continuing to be a viable investment class, is threatened if we don't keep in mind that global capital can and will move to other locations, and that's something that European regulators should be very conscious of. So with that, I want to thank you all for your attention and look forward to joining in on the next panel.